Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Dustin and Jonathan from Convoy Home Loans. How you guys doing?
Good. How are you?
I'm doing well. So thank you again for doing this with Vegas. That is the stratosphere and a palm tree, I think, out that window. Is that what I see behind me? Look at that.
Right.
Like, not like I've been to Vegas 150 times or something, but
Exactly.
yeah,
For
every conference. Hey, so you guys are at an event. I don't know if you saw this, but I want to share something with you and then ask you what the hell it means. So the 10-year treasury has fallen 0.11 today and is now trading under 3%. This, as people don't know, was just over 3.4, I believe, not so long ago. Guys, yeah, the 10 years under 3. What the hell is going on? The world, I mean, this can't be good, I don't think.
No, you were actually, to be honest with you, you told us 15 minutes ago this while we were getting set up for this conference, and we were kind of blown away. Right now in this market, like the 10-year treasury for the last, not the last 6 months, but prior to the last 10 years, have always been a pretty straight line indication of where rates are, right? It's always pretty much direct correlation with where rates are. The last 6 months, I mean, we may see a 40, 50 bip increase like we did from 3 to 3.4 on the 10-year, and rates may jump 0.5%. But I can tell you right now, when in the last week, when the 10-year dropped from 3.4 back to below 3, we haven't seen an eighth of a point improvement. We got some this morning that we're pulling up, but like, what was this? So so going back below 3, the difference in rates from a week ago, we basically are still up 0.375 from a week ago.
Yeah.
But the bond's now below 3.
Yeah. So let's just talk about the 10-year treasury. I'll give you my experience. You tell me if it's wrong or different or what you guys think. But the 10-year treasury for me has always been that kind of risk-adjusted return, right? And again, as I have a Wall Street guy on every Monday, and he's like, Michael, the smart money's in bonds, right? The smart money's in bonds.
Safe.
And with the 10-year under 3%, certainly backing up, what is that, 20%, right? From 3.4 to sub 3.
Yeah.
The bond market, the smart money is saying there's a recession that's the only thing I could tell you, right? They're putting more and more money to work, which means they're buying. It can't be good. This is not a good sign that the rates are now sub 3. I don't think.
No. And then, I mean, look at the stock market this morning. I woke up to like 1 million notifications of it just being
crashing.
Yeah. And that's like, everyone's kind of like, oh, we were just up. We made gained a little bit of grounds, and now we're back down to where we were like, a month ago? It's crazy.
Yeah. So I have a feeling the stock market, there's a guy I follow. He's basically a bear market or adjustment or whatever you want to call it. Has 3 phases. So phase 1, we're near the end of, but still in it. That is multiple compression, which is just about to be over. We've gone from 22 to 16. We may get to 14. What is next? Equally painful, which is this terrible thing to say, is earnings compression, earnings reductions. We're going to the earnings are going to come out in the next couple of weeks. Whack forecast, inflation, currency strength. And that's just going to hit the market again. And that's why I think the smart money is going into bonds. Hey, 3% is better than -10 or whatever they're going to get in the stock market, right? When I saw the treasury or the 10-year going to 3% today, all I could see on my head is recession flashing, right?
And it's even more so when the lenders aren't passing on it.
Exactly. They're getting a margin. Their margins are getting fatter.
Yeah, they're not passing it on. And then, in fact, a lot of our non-QM lenders, even with the bond moving, they're not moving down at rate because they're looking, like a month, 2 months, 3 months in advance. And they're like, we know that this is going to be a very temporary situation. Yeah. Everyone else can panic. We're going to hedge ourselves by pricing ourselves higher. That's what everyone's doing.
That's the beauty of the non-QM space, right? Again, I have a Matt the mortgage guy on who's, I think he's texted me 3 times today. It's like, it's crazy day, right? It moves all the time. But non-QM, right? You guys are playing a different game, right? Hundreds of millions of dollars looking out into the future. Again, 30 and 40-year money. And that's why it's more stair-stepped. It's not just willy-nilly, every morning you get an email with a new rate sheet.
You know what? Sometimes I do wish that we got improvements the same way.
Is it with the other way?
Yeah, but it's just unfortunately like all the non-QM lenders they're not adjusting down. Even
No.
like our if you would call it the portfolio lenders or whatnot that are more private money and that actually offer like really really great like rates lower than market. They're all adjusting to whatever the Fed says right now.
Yeah, I think there's a general impression in the smart money or the bond market that the Fed is going to do what they're saying. I think it's funny. So I talked to John why am I drawing it? Taylor is my Wall Street guy on Mondays. And he's like, hey, the bond market is basically saying we believe what the Fed is saying, but Wall Street or retail investors think the Fed's going to pivot and give up early. And he's like, this will be entertaining to watch, but historically speaking, the smart money is right. The smart money is smart money for a reason. I think retail is hoping that the Fed pivots, and it's not coming, I don't think.
I mean, yeah, a lot of people are waiting for a rate. I mean, I've heard more and more people like, oh, rates are going to drop. I'm like, here, no way. Like,
yeah, I don't know what I hear that every day on my channel. Oh,
Yeah.
Michael, you're wrong. They're going to cut rates in Q4. I'm like, Q4 of 2023? No. Q4 of 2022. I'm like,
No.
what are you smoking? What are you thinking?
yeah, I mean, we're already, in the beginning of the year, Powell said, what, 2% to 2.5 is where he was shooting
and
for.
now he's
We're
over
at
3.
1.75.
Yeah.
Now it's 3.44. We're halfway there.
Yeah.
So
yeah.
do the math.
I don't think the Fed stops until their Fed funds is at 4. What do you guys think? And that's next year. That's not this year, but next year, call it summer. What do you think?
I think they're just going to pause. We're going to have to stop lending at a certain point, right? The money's going to stop.
Yeah, it's funny. It's funny you bring that up. I actually had a video come out with another one of my experts this morning where I said the Fed is basically real estate's going to cause the recession, because I think real estate transactions will get cut in half. Real estate is roughly 15% of GDP. So if you cut real estate transactions in half, we could see 4% drop in GDP. I think we're going to have a real estate-based recession Q3, Q4.
I mean, that's scary to say, right?
Yeah.
It's like the scene in Big Short. I don't know if you've seen the movie Big Short.
Oh, many times.
Like, fuck, this is the crash of the economy. You
Yeah.
know, and like they just come to that realization. I mean, you just kind of brought that to light. Kind of scared me a little bit.
Well, here's the deal. It's as you know, 68% of purchases are home owner or owner ox. That's where the pain is going to come. They are interest rate sensitive. Investors on this channel, we don't care. We don't care if it's 7, 8, or 9. We just got to shop for that motivated sellers want to do a deal. I think there will be an air pocket that I'll call Q3 where there's price discovery. I think it's here. You think it's there,
So
but
it's a correction.
Yeah.
I always get asked this. It's a correction, not a crash, in my opinion, that's coming to the home values at least side.
yeah. But again, I think investors get more aggressive because we know what the cost of capital is. We can put it in our spreadsheet, and we do cash flow day one. We never do alligators. We don't bet on appreciation. We just hold for the long term. So I think a lot of the crash is going to come to, real estate agents. Oh my goodness, not good, not good. Mortgage brokers that rely on conventional, not good.
Yeah.
No.
Non-QM wins because you're better than hard money, and you do make sense loans.
Yep.
And your rates are kind of stupid low compared to what I used to get. So I think it's going to be, I think there is an air pocket in Q3, but I think it gets good after that. I think non-QM closes the year stronger than you started the year is where I think things will be.
Hope so. And maybe we can all go celebrate then, Mike.
Yeah, there you go. Absolutely. Absolutely. Well, hey, I'm going to, one of the things we're going to do when my channel gets to 50,000 subs, I'm going to have to bring you guys back to Vegas because I'm going to have an event in Vegas and just.
We're there.
Awesome.
For sure.
All right. So if somebody wanted to reach out to you and buy some stuff, use your lending programs, how should they reach out?
You can email privateclient@convoyhomeloans.com.
And let them know you came from one rental at a time. So you get the one and only Dustin or Jonathan or Justin, as I like to call him. They'll help you. Thanks, guys.
Thank you.